wealth conversation. Today we are going to talk about focused equity fund. Focused funds are equity mutual funds that have a concentrated portfolio of not more than 30 stocks. The investment strategy aims to pick the best performing stocks that can deliver high returns in the long run. Nippon India Focused Equity Fund, an open-ended multi-cap equity scheme, has been a consistent performer in this category of funds. To have an insight to Nippon India Focused Equity Fund, joining me today is Mr. Vinay Sharma, Equity Fund Manager at Nippon India Mutual Fund. Welcome, Vinay.
Thank you. Thanks for having me on the show.
Most welcome, Vinay. Let's start with the theme about this scheme. Tell us something about the Nippon India Focused Equity Fund investment philosophy and the objectives of the scheme.
So, the investment philosophy is pretty simple for us. We want to invest in opportunities where we see significant value creation potential over the next 3 or 5 years or medium term, however you define it. So as a fund house, we are not constrained by philosophies like growth or value or GARP or anything like that. We believe that markets at different points of time throws you different kind of opportunities. And given the flexibility in this fund, we can take advantage of the opportunities as and when they arise. So therefore, the idea is fairly simple. Find high probability of success where the odds are stacked in your favor, and find scalable opportunities for value creation in the medium term. That's the only philosophy we have. And the objective of the fund is obviously to generate returns for the long-term and medium-term investors. That's what equity asset class is meant to be. That is what it is for this fund. There is no difference in this fund or any other category in the equity category. Yeah.
With the market so much volatile these days, does it really make sense to invest in a focused equity fund, and why?
So, frankly, I think there's a lot of misconception about focused as a category, but the one line answer for investors to understand this category is this is nothing but concentrated flexi cap category. That's it. There is no difference between focused and flexi cap. The only difference is in a typical flexi cap fund, depending on the size, maybe you will invest in 50, 60 investments, but here you are limited to 30 investments by SEBI. That's the only difference. Okay. But the advantages that come with this category are also pretty much similar that are there with FlexiCap in nature, that you can straddle across market caps. Indian market has this tendency to give opportunity across market caps. Like 3-4 years back, small caps and mid caps were looking very cheap compared to large caps. Today, small caps and mid caps are probably slightly more expensive compared to large caps, given the nature of the businesses they operate in. And therefore, this fund provides you, or this category provides you, the flexibility to straddle across this market cap horizon. So that's the big advantage of this category, in my personal opinion. The other advantage of this category is that because of the concentrate nature and that you can only invest in 30 investments, therefore the conviction of the fund house and the fund manager clearly comes out in this. You would be that your opportunities are limited and you can't participate probably across all the segments that you want to, and therefore there would be high conviction wherever you invest in this category. So I guess that is why we like this category, because of the high conviction nature. And other than that, there is no difference in this category versus flexicap. So investors should just consider that as concentrated flexicap, nothing more, nothing less.
Vinay, as you said, your focus has to be on the 30 stocks because the allocation can be done in 30 stocks only. So how is the asset allocation done by Nippon, and what is the portfolio composition of the fund? It would be very difficult to really shortlist just 30 companies from the list of 5,000.
So yeah, in terms of asset allocation, see, there are broadly 4 or 5 criteria. Then I'll start from the macro part of it, the top, and then come down lower on how do we go about stock selection. So on the macro side, the first question is always cash versus equity. We don't believe in taking high cash calls, so therefore cash calls are fairly limited unless there is an extreme environment somewhere. Okay. Now the second call is how would the allocation be between mid cap, small cap, and large cap? As I stated earlier, we are fairly flexible in that way. But as a strategy, we run this fund between, say, 55 to 75 large cap and anywhere between 25 to 45 mid and small cap, depending on where valuation is on your side. So that's the broad asset allocation metrics. And after that, obviously, one has to decide which part of the economy you are more sanguine about, whether you want to invest more in global stocks, you want more domestic focused stocks, you want more exposure to cyclicals, you want more exposure to defensives, growth stocks, value stocks. So all of that one portfolio manager has to decide in all points of time, irrespective of the fund he manages. So that's it's pretty similar here. So yeah, broadly, this is how the broad macro asset allocation happens. That which are the sectors you are bullish at this point of time, and then finally the most important questions after identifying the themes and the sectors. Which are the companies where you find the risk reward attractive, where you believe that significant scale or value can be created over the next 4 5 years, where you believe in the management capability to execute, and etc. etc. So bottom up stock picking is the core of the asset allocation, but on a macro level, as I told you, we do straddle between how much large cap, small cap, mid cap, all those things.
If we study the fund's major allocation, is the bend is towards the banks. It's 27 plus percent plus in banks. Of the total 10 top holdings that you hold, 4 are banks. What makes you interested in this sector and why?
So let me again start from a top-down view. From a top-down view, we are quite optimistic about both domestic and global recovery at this point of time. We believe that post-COVID, there will be strong recovery both in developed markets, in emerging economies, and Indian economy is also showing signs of coming back from COVID. And some of the frequent indicators are pretty solid at this point of time. And we believe this will gain more momentum in the second half after the festive season, because that's typically the busy period of businesses and all of that. So therefore, overall, the portfolio is tilted towards cyclicals today. And obviously, if you want to find the one large scalable sector which correlates positively with both corporate recovery and consumer recovery in India, it has to be financials. And while you said that the top 4 5 positions are banks, they are actually not banks now. They are all financial conglomerates in nature. If you look at the underlying businesses, there is one lending entity, but they also have one insurance entity. They have an asset management subsidiary. They have a general insurance subsidiary. A lot of them, not all of them, but a lot of them. And therefore, the value that comes today is a mix of both the lending business and some of these other subsidiaries that we talked about. And we are fairly positive on both lending and non-lending businesses at this point of time. We believe credit growth will recover as the economy gains momentum. And credit costs will go down because India is coming out of a long 4 5 year bad loan cycle, and that cycle is coming to an end today. And therefore, costs will come down, credit growth will pick up. It's probably an ideal situation to be. And with all this, valuation seem very reasonable. This is one of the sectors which has not really truly participated in the the upheaval that we have seen in markets over the past few months. Banking has relatively underperformed a large segments of markets today, and therefore we think valuations are also on your side. So it's a mix of everything. We are bullish on business fundamentals, valuation on your side, and we believe banking cycles are fairly long. So you have seen the last 4 5 years, which were not so great for the banking sector as an entire sector. Obviously, some companies did well, but we believe over the next 3 4 years, you could see a culmination of higher growth, lower cost, and valuations on your side. So that's why we are quite optimistic on banking as a sector, and it does. There's a big part of the portfolio which is allocated to that sector.
Which index is this fund benchmarked against, and what is the criteria for stock selection? I understand there has to be a very in-depth research into companies, right?
Yeah, so the benchmark of this sector is BSE 500 because, as I said, this is a fund that can move across market caps, and therefore BSE 500 represents the broader markets in general, and that's the benchmark that we have chosen for this sector. Now, coming to stock selection, I can probably talk about that for a very long time, but probably I'll try and give you 4 5 strong points on what we look at when we are looking for the investment. So first is scalable opportunity. We have seen that when the fund grows, if you want your companies to grow with the fund, obviously the companies have to be in scalable sectors. So that those are the kinds of opportunities we look for that can grow as with changes in social, economic, technology, demographics, with all those companies that are benefited positively with the changes that are happening currently. So that's the first criteria. Second, we believe management execution and management pedigree has to be superb. So therefore, either management have great track record, or if it's a new IPO or a new listing, then our personal research and belief of how the management has executed in the past and what are they likely to do in the future. So management execution becomes a important criteria. Third important point which we look for is great companies which are in temporary down cycle, or the sector is not doing well, or there is some temporary issue that will go away with time, because markets have this tendency of extrapolating current present into the future. So therefore, if you can find a great company in temporary issues, that's a great starting point for your investment. So, for example, if you look at just a few quarters back, PSUs were out of favor in the market, and really not a big part of portfolios across the industry. Similarly, leverage was a bad word a few quarters back, and leverage companies were totally out of fashion. Whereas if you look at returns that have come over the past few quarters, leverage companies have given some of the most stellar returns they've given in recent past. So therefore, if it's a temporary issue that we think the management or the industry or the company would solve in a few quarters or years, and today the value is substantially lower than what the intrinsic value of the company should be, that's the kind of opportunity we really love. On the negative side, we really don't want to get into companies or sectors which are going through technology change or technology upheaval. Technology is not a battle that we want to fight at all. We really want to be on the side of technology, companies which benefit from technological changes, because technology has become such an important paradigm for every business today. And therefore, we stay away from sectors where big technological disruptions can happen. I guess broadly that covers what I would like to say about how we go about our stock selection. It's a combination of sustainable competitive moat, optional value in business, scalability, and management quality.
So how have the historical returns been so far, Vinay, and how long should one stay invested for decent returns?
So let me start by saying that past performance is no guarantee for future returns. The standard caveat, but if I remember correctly, we have delivered close to 20% return over the past 3 years, CAGR. That's what we have done. And on how long the investors should stay in the fund or the category, I would say investors should stay long term when they are investing in a concentrated fund like this, because whatever your fund manager or the fund house is thinking and the thesis, it takes time to play out. Businesses take time to grow, and so therefore you want to be with your fund manager in playing out the entire cycle. So this is a fund for medium to long term investors. I would define medium to long term as anywhere more than 3 years probably. That should be your investment horizon. Was there anything more to the question?
No, that's it. I mean, for decent returns, one has to stay invested long term, which is in excess of 3 years, right?
Yeah.
Oh, and why should investors look at this fund as a great investing option? And which category of investors should really opt for this fund?
So before coming to the fund, let me start with why we really like this category. Why focused as a category is a good investment option for long-term investors. See, as I said earlier, the big advantage of this category is that SEBI has given all flexibility in it. You can straddle across market caps. You can move from large cap, mid cap, small caps. So therefore, there is no restriction on how much of your portfolio needs to be allocated between various market cap classes. That's one great advantage of this category. The other advantage of this category is, as you said, because you have 30 investment options, the fund manager or the fund house needs to go into in-depth detail in each of his investments. There has to be very high conviction behind all of your investments. So that's the other big advantage, that whatever the fund house or the fund manager truly believes in would come out clearly in this fund. So if you're bullish on certain sectors, on certain themes in economy, on certain demographics changes, whatever you are playing for would come out very clearly in this category, and that is why we believe this is a good category for investors to be invested in. From a fund point of view, why you should invest with us is, obviously we have a experienced team. We have seen who has seen economic cycles, market cycles across years. We have now inbuilt processes, not just in terms of investment management, but risk, and how risk has to be managed has become an important part of our core philosophy. And plus, now with Nippon as the parent and actively involved in management, we now have the best investment practices from across the world to take advantage of. So that is why we believe you should invest in Nippon Focus Equity Fund.
Vinay, one last question. Which category of investors should really get into this fund? I would mean that is if somebody is aggressive or if somebody is conservative, who would opt for this kind of a fund?
So again, as I said, there's no difference between this fund or this category versus any other flexi cap, large mid cap, all those sort of equity, mutual funds. It's the same, except for the limit of 30 stocks. There's no difference between this category and those categories. So investor has to think long term, at least medium term to long term. That's what equity as an investment class demands from investor, and that is what investors should follow, in my opinion. So if you are looking to invest in this fund or this category, you should have a medium to long term horizon. Otherwise, in terms of volatility, in terms of diversification, this category would ballpark be similar to a flexi cap category.
Thank you, Vinay, for explaining what makes Nippon India Focused Equity Fund the most attractive investment for wealth creation. Thank you very much for your time.
Thank you. My pleasure.